Hello, investors. Welcome to one more monthly interaction with Canara Robeco. Last month has been an eventful month. There were two or three key events that happened. The most important being the budget. Of course, on global front, there is a continuity of actually Trump taking over and its implications on tariff side and others. Uh, Third, the earnings season. So let us discuss them one by one. Let us start with the global aspects first. Clearly, Trump administration actually came in place last month, and as was expected, the tariff-related noise has actually gone up. As we have been saying, that in our assessment, a lot of these supply chains which have been established over a long period of time cannot be unwound in a very short span of time. So a lot of this tariff related basically noise or tariff related noise is, in our view, is more of a tactic to actually extract as much as possible from the countries like Canada, Mexico, China and the other emerging markets. So our view still remains that while there is a lot of noise around these things, changing supply chains overnight by putting tariffs is the worst option that US itself can choose, and that's where our view is that while you will have these noises, what it would lead to is probably a lot of concessions to US by using this as a tactic, and it will extend to other countries as well. So as of now, the noise has been predominantly to with respect to Canada, Mexico, Colombia, and China. Our sense is it will extend to Europe and other BRICS nations as well. So that's the first thing. A lot of noise, probably more a tactic to extract as much as possible. We don't expect it to lead to trade wars, at least at this point in time, given the integration of supply chains that is in place for a very long period of time. So that's the first aspect. Second is, of course, given the promises or the poll promises that happened in US, there is general expectation that the corporate taxes, the taxes will be cut, so the fiscal deficit will be cut, there will be growth focus, and thus US might end up doing better than a lot of other markets, and that's where capital has been flowing back to US from both the emerging markets as well as developed countries. Our sense is you have seen the peak of it as well, and that's just a hunch that you have already seen the peak of it, whereby it is like you buy on rumor and sell on news. That's where you saw the bond yields in US moving up when the election outcomes came, the dollar index moving up, the US market moving up. Our sense is now the rumor has been converted into news, the administration is in place. Now the reality will gradually actually come to fore. And as that happens, our sense is while there will be incremental positives for US, they might not be as dramatic as market was believing. And that's where the capital flow related challenges in terms of the pace at which the capital went out of emerging markets might slow down or might reverse based on the earnings growth valuation context of individual emerging market and developed countries. So I wouldn't be surprised over next 3-6 months that you start seeing reversal of capital flows in the emerging markets where the earnings valuation context is good, in the markets where the macros are good. India figures as one of them. Of course, we have earnings challenge in near term, valuation challenge is getting addressed. So those are the 2 or 3 key aspects on the global front. Coming to domestic, clearly, while most of the macros remain good, I think one stress point which has come to fore lately is RBI spending $50 to $70 billion trying to defend the currency, and that leading to effectively liquidity tightness. While RBI has actually started acting through OMOs and other in terms of providing incremental liquidity, I think that's the external challenge on currency side that will persist for some time, given the strength of the dollar index. But again, like I said in the previous part, our sense is the worst of it you have mostly seen. That's our guess if we have to take a guess on that. Apart from that, I think most of the macro indicators still remain good. India still is characterized by the economy where the macros are extremely good, the balance sheets are extremely good, but there is a little bit of growth slowdown led by government, actually incremental government spending coming off, and that's where budget comes in picture. Budget clearly was a continuation of that factor, that government itself is gradually readjusting its spending between revenue expenditure and capital expenditure, and that's where you saw that basically government actually indicated that after spending probably or falling short of spending the infra spending last year, the last year capital expenditure according to budget was 11.2 lakh crore rupees, revised budget is 10.2 lakh crore rupees. On that also, the growth in infrastructure spending or capital spending has been actually is limited about double digit, low double digit, or high single digit to low double digit. Instead of that, government has actually chosen this time after a long period to spend little more on the basically mass middle class, mass poor. Both the revenue expenditure has actually started moving up little bit, which has gone up to 7-8% growth, which is one of the highest in last few years, as well as basically government actually giving tax benefits, direct income tax benefit, which roughly is a lakh rupee per head for all the taxpayers who are below 12 lakh and even above 12 lakh. Effectively, it's a saving of a lakh rupee per head, which can actually get redirected towards the repayments of loan, savings investments, as well as basically consumption. So that was clear highlight. The budget was extremely good in the circumstances. Government managed to actually continue to walk the path of fiscal prudence, where they guided that next year would be 4.4 and then probably it will further go down in 27. So they continued on that, and at the same time they managed to have basically capital spending, which is infra spending, which is almost double digit, and at the same time they also managed to actually help the consumption part of the economy, which was really struggling. While the number of a lakh crore rupees of total amount on consumption tax benefits is low, but it is at least incrementally positive in the context that gradually you are experiencing that the state central government combination is redirecting its spending towards incrementally towards consumption, towards urban poor, towards rural poor, towards urban and rural middle class, as against the past few years where it was predominantly directed towards capital expenditure as well as probably in a way corporates by giving them some benefits. So that's a clear shift that is visible, and the combination of 1 lakh crore spent by or likely to be spent by central government as well as the roughly 3 lakh crore rupees of state government freebies across about roughly 15 states, which is basically at a state level which is happening. Clubbed together, this is a sizable number of 4 lakh crore rupees, which is going towards middle and mass middle income group as well as the urban and rural poor. So that's a good number, and that's where we said that gradually there is a balancing act that is happening from a political establishment between the capital expenditure and the consumption expenditure or revenue expenditure, and that's in a way good, because one of the clamor that we were hearing from corporates is that yes, we want to do capex and we are doing capex. The private capex is happening at a CAGR of 10% roughly, but we can't increase it because the consumption part of the economy is really weak. And thankfully, these measures by state governments and now central government in budget are likely to drive a little bit of a consumption at the margin from where it was, and that's a good news eventually for capex also. Having said this, a lot of people had this worry, does it mean that the capital expenditure is falling through completely, or is it going to decelerate significantly? Our sense is not. Government has not taken a U-turn. Government has just readjusted its spending based on the need in a particular part of the economy. For last 10 years, government has persistently been trying to actually fix the supply side, which means the capital expenditure was a larger part. After spending so much of time on that side, government has realized probably there is a little bit of a focus that needs to bring on the revenue expenditure, consumption expenditure, and that's where the focus has gradually shifted. But it doesn't mean that the industrial cycle or investment cycle is over or anything like that. Of course, there was a froth in that part of the market, and that is getting corrected, but we have no doubt that this cycle is here to stay on that side as well. That's largely what happened in the budget. Coming to earnings, I think the persistent challenge and bigger challenge for India has been the budget is over, and the market will move back to the earnings growth, and that's where I think the bigger challenge is, because the government expenditure was low this year and consumption was struggling and exports was struggling. You have had deceleration of GDP growth rate from RBI's own projections of 7.2. Probably eventually will end up between 6 to 6.5 according to consensus. That deceleration has also led to earnings actually slowing down. From last year's 25% earnings growth for Nifty, this year the earnings growth is likely to be low single digit, and that's what is flowing through in third quarter also. We have largely concluded the numbers. Probably 70% of the third quarterly earnings are out. Almost 70-80% of Nifty earnings are out, and what it is indicating again is that this quarter also you are going to have earnings growth which will be probably low single digit, which is clearly huge deceleration particularly in the context of where the valuations were, where the expectation was of market and consensus last year. And as that is happening, you are going to have rebalancing and readjustment of this dynamic between the earnings growth valuation context. Since there was a lot of upfronting of valuation that had happened last year, now you are witnessing the correction of those valuation multiples as the earnings are actually being fairly moderate as compared to what was expected. And that readjustment, in our view, is likely to continue. Having said this, our assessment is in last 6 months, if you look at the market is roughly, the large caps are down roughly 10-12%. The broader market is probably roughly down anywhere between 12% to 15-16%, depending on the index that you are talking about, from peak to low. And as that has happened, while the portfolios have corrected by that much, or indices have corrected by that much, there are a lot of broad market companies and sectors which have corrected far more. And to that extent, our view is, while the earnings will still remain muted for some time, and they will start gradually improving from fourth quarter and then next year, financial year 26, according to consensus, our sense is the market has kind of taken out a lot of froth that was there in certain parts of the market, particularly in broader market. And to that extent, we see financial year 26 to be a good opportunity to incrementally allocate and actually watch out for the earnings actually recovery as it happens, and then actually take incremental view. But as of now, the valuations for large caps have clearly come in a fair zone. The large caps are trading at something like 18.5 times roughly financial year 27 earnings, which is 1.5 year ahead. Clearly in a fair valuation zone, if one has to take a 1 year view. It's in line with the historical averages for last 10 years, or below historical averages if I take 27 earnings. As far as broader market is considered, which is mid cap and small cap, they are still probably 15-20% expensive than the historical levels. And that's why our view still remains in that part of the market. You might not get the kind of price correction that you already seen, but based on the earnings, you might still see combination of price, time, and more of a time correction over next few quarters, depending on which part of the broader market earnings play out and which part it doesn't play out. And to that extent, in that part of the market, still the valuations at portfolio level remain little elevated as compared to historical levels, probably 15-20% higher than the historical levels. But large caps have largely come in the fair valuation zone. That's the way we are looking at market. So from near-term perspective, the caution that we were actually guiding for last few months, probably last 6 months, I think we actually turned that view gradually or moderated that view. And now we're saying probably the froth has been taken out. Yes, you might not immediately make returns. You might not immediately get good outcomes because the earnings are still fairly weak. But if the earnings play out the way consensus is saying over 26-27, as you go into next 18 months, it wouldn't be a bad idea to actually start incrementally allocating, whether it is large cap, mid cap, small cap. If one is on the large cap side, probably you're better off, or there is no harm allocating in one go or lump sum because the valuations are fair from a historical perspective. If one has a 2 to 3 year view, mid cap, small cap, probably taking a 3-5 year view with a keeping volatility in mind, keeping the earnings challenges in mind, but allocating through a systematic plan would be a better idea in our view. So that's how we are looking at market. Clearly, we have actually downgraded one notch in terms of our negative view or circumspect view on market based on the correction that has already happened over last 6 months in market. In terms of sectors, while the budget and state governments are clearly indicating tilt towards consumption, in our view, in our portfolios, we continue to be barbell, whereby on the consumption side, consumer discretionary, telecom, aviation, hospitals, hotels are the spaces, and select retails are the spaces which are overweight. And on the cyclical side, the global cyclical IT, which is equal weight, and the domestic cyclical, which is industrials and auto, which put together still continue to be overweight. So that's the portfolio positioning for us as a house. Of course, at individual portfolio level, it will be a little different. I think that's largely from our side for this month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.